So basically the journey from 2012 to 2020, so the first kind of decade or so of alternative risk premium performance. This is from a paper I wrote a couple of years back with my friend Matthias Lenk, called Here in the Real World, the Performance of Alternative Beta, which is another name for alternative risk premia. So basically what we had was net of fees, quite respectable performance for the last 5 years or so, from 2012 to the end of 2017, January 2018. Sharpe ratio of 0.7, net of fees, not bad. Basically, on the chart you see the fund portfolio, that's in blue. I have a investment bank alternative risk premia portfolio, which has statistically similar type of exposures to the fund portfolio. And I have the HFRX Global Hedge Fund Index in gray. And actually ARP beat the HFRX index during that time. Now, since January 2018 to the summer of 2020, it all went downhill, and we had essentially an 8-year eventful journey to nowhere. So basically, all those gains were given up in the next 3 years. If we drill down a little bit into the data, what we do find is that whilst the returns from 2012 to 2017 were reasonable on a risk-adjusted basis, even net of fees, we could ask the question, well, did ARP really diversify your portfolio? So, and the answer is, well, not really. You can explain a lot of that performance just by reference to traditional assets, equities, bonds, and to some extent to commodities. And even more so, and this is, again, paper that Kari referred to that we co-authored a few years ago. If you look at the tail exposures of these strategies, you will find that there is a lot of it, and most strategies are indeed tail correlated to either equities or bonds.